Welcome, folks. Greg Ring here, co-founder at the Giving Crowd. Hey, thanks for taking some time to spend together. We have a lot of folks from around the country. We have, I think, business owners, property, real estate owners, some professionals, as well as advisors, wealth advisors around the country that we have the privilege of serving and working alongside at the Giving Crowd. Our aim today, my goal for you as a client, as a business owner, as a generous person, is to help you, give you some ideas on how you might be more tax efficient, be more wise or in your stewardship, whatever giving you do, whatever the charities are. Our aim is to help you be more effective in how you do that. I have, as you'll see in a second, 42 years I've been doing this. We've done several $1 billion of gifts around the country and other parts of the world, working with generous folks like you. So rather than me rambling more, I'm just going to share my screen and we'll jump right into this. Thanks for taking time. And the outcome, my goal for you is if you find this interesting, kind of stimulate your thinking, then we'll offer at the end to get together with you and your wealth manager, your financial advisor, and do kind of a more private Zoom call. We won't be doing open questions on here because so much of what you'd want to bring up, so many of the questions that you would want to ask are going to be personal and may not be questions you want to ask in a public setting. So you will have an opportunity to have a private conversation if that would be helpful to you. Okay, so balance sheet philanthropy, the merger of traditional plan gifts with current charity impact. So I'm Greg, co-founder with my business partner, Richard Blackman, at the Giving Crowd, husband, father, grandfather, 42-year veteran in philanthropy, which seems like a long time to me. We've done just almost $5 billion in documented gifts of the kind of things that you're going to be seeing. And this is a picture of my wife and I. We met when she was a senior in high school and I was a freshman in college, and celebrated our 46th wedding anniversary just a couple months ago. We met at Central Missouri State University, home of the Fighting Mules, if that helps establish my credibility in sharing this information with you. So here's the question. All of you on the call here, I believe, are involved in one way or another with a local charity, as a board member, as a volunteer, as a donor. And so the question is, how will your favorite charity build the future? And the reality is that of the 480 billion or more given last year in America, the vast majority of that was people writing checks. And that's probably the case for most of you on the call. Maybe some of you are giving public stock out of your stock portfolio, but probably very few of you have given closely held family business stock or real estate or oil and gas or cattle. And the reality is that the average American has about 9% of their net worth in cash. 91% is in stuff. It's in assets. It's in things like your vacation house or your IRA or your business you own, or you have a rental property. And so this jar over here on the left represents that 9%. And that's where most of the charities, virtually all of the charities in America, spend their time. 1.5 million nonprofits chasing this 9% that's represented by cash. 91% over here is in assets, and that's where we live, because we know that in most cases we can create significant tax benefits to you if we can educate you on how to tap into this jar rather than your checkbook. And particularly when you're in, some would say, a little bit of an uncertain economy right now. Where are we going? I find that business owners in that environment are even more likely to protect their cash because you don't know what things look like in the fourth quarter of 2023. I had dinner with a gentleman in Chicago years ago. He was an attorney by training, but working as the chief operating officer of a publicly traded company. one that most of you would know. We were having a great dinner downtown Chicago off the loop there. And in the course of dinner, he said, you know, what my wife and I do is at the end of the year, we just sell enough stock to fulfill the different pledges we've made. And I said, well, okay, you know, you could just give the stock to the charity and let them sell it. And his comment to me was, well, 6 of one, half dozen other. I said, well, it's really not. Because when you sell the stock, you're recognizing all of that long-term capital gain, and you're giving the after-tax cash to the charity. And there's this long pause in the conversation, and he finally said, well, wow, we have wasted a lot of money, because the bells went off in his head and he realized what I was saying. But here's an example. Let's say you bought some stock years ago for $10,000 and now it's worth $100,000. If you do like our friend in Chicago and you sell the stock, what that's going to leave you with, just at a federal tax level, is $78,000 after tax. You got federal taxes of $21,000 that you're paying. In some of the states on the call here, like California or Minnesota, where your state income taxes are much, much higher. Instead, if this gentleman in Chicago had just given that $100,000 of stock to charity, now the charity sells it, they pay no taxes, he gets a larger deduction and more money goes to charity. If he wanted to give $100,000 and he'd already sold the stock, he has to dip into another pocket to come up with the balance, to come up with a $22,000 balance. So that's a real simple example, and many of you are already doing that. So I guarantee you, we're not going to stop there. I want to get into the big jar in a deeper way. But that's the fundamental principle, is how can we identify pre-tax philanthropy opportunities in your portfolio, and how can we work with you and your advisor on structuring that in a way that maximizes your benefits. That's where we're going in the next 25, 30 minutes or so. As you look at assets, there's a lot of categories. You know, we have, I'm told, about $20 trillion in IRAs and 401ks in America. We're not going to touch on that today. That'd be a good topic for another day. But VIP Forum has said that 82% of baby boomers will sell their family business as they approach retirement, rather than pass it to the next generation. Now, I was just on a Zoom call 30 minutes ago with a guy selling a very significant company. It's estimated to be about $176 million sale. And he's looking at whopping taxes. It's a California company, so just a tremendous amount of taxes he's facing. And the preliminary set of illustrations we've done for him will drop his taxes by more than 65%. Real estate values have taken off, and they've dipped a little bit in the last 15 months or so, but they're still highly appreciated. And those are two categories that I'm going to share examples of how we could help you be more tax efficient with your generosity. Last year, we had a tech company and $192 million company. We worked with 2 of the 4 owners, and we reduced their taxes by 71%. Interestingly enough, the other 2 owners, their solution to reducing the taxes was to move out of California to Texas to get out of the high state income tax or state capital gain taxes. Well, that's a pretty drastic move. You have grandkids in California, you're going to move to Texas to get away from the taxes. You're also getting away from the grandchildren. But our solution was much more attractive to the spouses, but still was able to save them 71% in taxes. We had an ag business, same time going on. And this couple had the largest law firm in their state and one of the big 4 accounting firms. And nobody brought any ideas that recognized this couple's desire to be generous. Now, if you're not interested in giving, if to you giving to the government or giving to charity is the same thing, then honestly, this webinar is probably not for you. If you feel that giving to the government is something that you'd rather not do, we call that involuntary philanthropy. I was having lunch with a guy in the Petroleum Club in Dallas years ago, and he said, you know what, my wife and I have just never really been philanthropists. And I said, you know, you're going to be a philanthropist when you die. It's just a matter of who picks the charities. So that is what we call involuntary philanthropy. What we would like to do for those of you who are interested is help you shift from involuntary to voluntary and become proactive. For this ag business, our plans reduce their tax bill by $14 million. So that's serious money. Now I'm going to give you some examples all over the map on much, much smaller situations, but for those of you who do have a larger situation, I just want you to know that in all likelihood, we could come alongside your advisors and together work as a team and dramatically reduce the tax bill. So just consider whatever appreciated assets that you might have, including public stock, and let's see if we can't reduce or even eliminate those taxes. So what we're going to talk about later is we'd love to get on a Zoom call with you and your advisor that brought you to this webinar and just kick ideas around, just explore, and you can ask questions, and there's no obligation. We're just happy to see if we could be helpful and give you some ideas that might be new. We had a couple that had in 1980, they had paid $82,000 for their first home in Los Altos, which is Silicon Valley, California. Well, oddly enough, that house appreciated from $82,000. When they finally sold it, they had converted it in the 90s into a rental house. And now 2 years ago, it was worth $3.1 million. And they transferred half of it into a charitable trust and half of it they sold outright, but it dropped their taxes dramatically. We had a farmer in Iowa that had accumulated 160 acres here and 320 acres there, and now he's getting ready to retire. His kids had all moved off of the farm, and so he was beginning to downsize, and he took a couple of those farms and put them into a tool called a donor advised fund and sold them tax-free. We had a couple in Wisconsin that had about $4 million in their stock portfolio, but they were writing checks to charity, like the guy at dinner in Chicago. And we worked with their advisor to help him cherry pick the stocks that would be the best stocks to give to charity. And in their case, interestingly, what they did is some of the stocks, they just loved the stocks. They felt like they were going to continue to grow in value. So the advisor, after 30 days went by, they just repurchased the same stocks that they'd given away with money they were going to give to charity out of their checkbook. They just repurchased the stocks now, and now they have a new higher cost basis. So if they do sell them in the future, they're not going to pay as much in capital gain taxes. So we would work with you and your advisor to help you just look and explore on what might be the best options for you. It is not a one size fits all. It really is tailored to where you are. If you're 45 years old, that might be different than if you're 75 years old. If your kids are out of the nest and doing great, it might be different than if you're having struggles with your children. You might be focused on grandkids, on getting them educated. So, I mean, every family is different. And that's where we would work with your team on structuring something that hopefully would be fresh and new and save you some taxes. Here's the key. If you think you might be selling any appreciated asset in the next 12 to 24 months, just hit the pause button, just slow down and let's have a conversation. Even if it's a couple of years away, this would be the time now to look at your options so that you have time to just process it and think about things and talk with your spouse if you're married, talk with your other advisors, rather than us getting a call from you and your advisor saying, hey, we got an offer on the company. They want us to sign this contract in the next few weeks. We sure want to get some stuff done. And then it's a white knuckle landing. It's just much more stressful than if we can do it a couple of years in advance and then take the plan, put it on your bookshelf, and now it's ready when you get that offer that you want to accept. So I'm going to give you a couple of examples. We talked about the $192 million tech company. Let's bring it down a little bit to more of a middle America scenario. We had a couple that had their career in Texas and they moved to California for retirement, obviously not to pay higher taxes, but rather because that's where all their grandkids were. And this husband was having lunch with the president of one of our charity clients, and he said, when we get this warehouse in Dallas sold, we're going to be able to make a nice gift to the campaign. And he said he was thinking about a $25,000 gift, which for them would have been the largest gift they'd ever made. Well, the president of the charity said, well, you know what, have you already sold it? He said, no, I think we know who's going to buy it. It's one of my business associates, but no, we haven't sold it. He said, well, before you do, you ought to talk with our friends at the Giving Crowd and just see if they could be helpful. So we got a call from the guy, and long story short, we took the warehouse and we divided it into two components. 60% went into a tax-exempt trust called a charitable remainder trust. Now, you may have heard of this. It's been around for more than 50 years, since 1969. It's a tax-exempt trust because you are making an irrevocable commitment that when you pass away, or if you're married, when you and your spouse pass away, the corpus, the principal inside the trust, is going to go to charity. But during your lifetime, there's benefits coming back to you. So the trustee sells that 60% to the buyer, and now the benefits coming back to you are you pay no long-term capital gain taxes, no taxes when you sell the warehouse. Number two, you're going to get a big deduction, which is not just this number, but it's one coming up over here. And number three, you're taking income out for the rest of your life. So we often see scenarios where somebody has an apartment building or a rental property or a family business, and they want to be generous. They don't want to pay the taxes, but they also need income for retirement. So this charitable remainder trust can be a great way to eliminate the taxes, create charitable deductions, and have the benefit of income for your lifetime. So your advisor would now take those dollars and in this case, the $500,000, and they would invest those in a portfolio. And so you would work with your advisor on that, and they would be generating the income now that's going to come back to you for the rest of your life. But meanwhile, you've sold this tax-free. For this couple, the other 40%, they just gave directly to charity. The charity sold that to the buyer. Now the buyer writes one check to the charitable remainder trust and a second check that went directly to the charity. So what was going to be a $25,000 gift became a $337,000 gift because they're not giving out of their checkbook, that jar with a 9% in it. They're not giving out of there. They're giving out of assets in a much more tax efficient way. All right. And by the way, if you want to jot down questions, again, if we get together and we have a one-on-one conversation later on, we can answer all those questions. Happy to do that. This is another real estate example. This couple had a farm that they'd owned for years, and their CPA told them that if they sold it, they were going to pay $800,000 in taxes. They had two other farms and their house, and then some investments that add up to $4 million. Well, this property here, they wanted to sell because they've been renting the property out. The husband, he's 83 years old when we helped them. And in his words, he was off the tractor. So they've been renting the property out, and their rental income was running $18,000 a year. So if you do some quick math on that, that's 0.5% return. So they thought, gee, if we could invest this, we could do better than 0.5%. But the CPA said, yeah, but you're going to pay $800,000 in taxes. Well, the wife was not interested. I won't quote her exactly, but she said, I'm not interested in sending those boys in Washington $800,000. So that's a paraphrase. So what we did is we took 5/6 of the farm and we transferred it again to a charitable remainder trust. Again, sold tax-free, and now The benefits to them are they sell that portion of the farm tax-free. Now then, they're taking out $150,000 a year of income instead of $18,000. So a big bump already, a big change. And then they also got a charitable income tax deduction. By the way, you can use that deduction in the year of the gift, and whatever you can't use that year, you can carry forward 5 years. So it's really about a 6-year tax holiday. It's not like you won't pay any taxes, but it'll be tax reduced because of those deductions. The other 1/6, they transferred into a tool called a donor advised fund. Now, this may be another one of those things you heard about. Let me review it just quickly. It's the most popular charitable tool over the last 40 years. It's another tax exempt environment. My wife and I have had one for more than 20 years. We call it our charitable checking account. All of our giving comes out of our donor advised fund. You could put cash in there. You could have some come out of your paycheck. You could put some land like this in there. You could put publicly traded stock. But what we do is all of our giving comes through our donor advised fund. And there's 3 benefits I want to touch on. One is it simplifies your tax filing. Just 2 weeks ago, I got the report from my donor advised fund with an itemization of all of the giving that we had done in 2022. Instead of waiting for all the different charities we gave to last year to get around to getting us our tax receipt. So it simplifies tax filing. Number 2, maybe I'll just do 2 benefits right now. The second one is that I bet you get invited, like my wife and I do. We'll have friends that they bought a table at a charity banquet, and they've got 2 empty seats, and they're trying to fill the table. So they call us, and they say, "Hey, this is going to be fun. Why don't you come to this banquet with us?" And so we go, and I don't want to go and just listen to the pitch and then leave. So we call up our donor advised fund, and we say, "Hey, cut a check to this charity who we currently aren't giving to, and we say for this amount of money, but we want to be anonymous." So now I've got a check I can drop in the basket at the end of the evening, but I'm not on their mailing list, because we want to go deeper with the charities that we do give to instead of being spread a mile wide and an inch deep. So this way I can be generous that evening, but not get a call from a development officer, the next week wanting to take me out for coffee. And I bet some of you are resonating with that benefit. So those are 2 benefits. So the donor advised fund is another tax exempt environment. So 1/6 can go in there. And now the buyer writes a check for $600,000 back to the donor advised fund. And the reason this couple did this is that they had multiple charities that they wanted to give to. The previous example, there was 1 charity they wanted to benefit. This couple had, I don't remember, 7 or 8 different charities that they wanted to give to out of that $600,000. Well, that leaves this $4 million. And that's what was going to go to their adult children. But they also had $2 million in an irrevocable life insurance trust. Some of you probably have life insurance inside of an ILA, an irrevocable life insurance trust. You can see it's outside of their estate, therefore not subject to federal estate taxes. And in this case, the children, they had 2 adult children, both working. One was an attorney, and one actually works for a nonprofit. These 2 adult children will now split $6 million tax-free. So that's what's going to go to their children. That's their children's inheritance. The husband said that's a lot more money than we had when we got started. So this couple was able to be generous with their children. They eliminated $800,000 of taxes here when they sold. Their income went from $18,000 to $150,000 a year, and they were able to make the largest gifts by far of their lifetime, because these are farmers. These are farmers with not great cash flow. And so it was a wonderful transformation for them from a pretty punitive tax situation to a very generous situation. So in each of these, I'm just going to do a couple more, but I'm hoping that you're seeing that in each of these cases, there's ways that we can I like to say, disinherit the government in favor of charity, allowing you to shift from being an involuntary philanthropist to a voluntary philanthropist. This couple had they had two businesses and then a bunch of real estate up in Idaho. And this gentleman said to me that his two sons were running the company that's on the screen. And he said, Greg, I got to tell you, they're doing a great job. I'm really surprised. I've been giving them more and more control over the last 5 years, and now they're really essentially running the business. And they've been growing it at 12 to 15% a year. And he said, I'm surprised, but I'm really proud as a dad. I said, well, you should be proud. That's really impressive. And he said, here's my question. I'd like them to have ownership. Right now, they're just getting a paycheck. And if I decide to do that, but they don't have any ownership. And I'd like to reward them with some ownership in the business. I said, that's great. I would agree. I think that makes a lot of sense. He said, yeah, but if I sell them some of my stock, I'm going to pay a bunch of taxes, long-term capital gain taxes. If I give them stock, I'm concerned that they're going to feel entitled, like they ought to have stock in the company because they're my kids. And I don't want that. I want them to have an ongoing motivation to keep performing, to keep working hard, to be creative and entrepreneurial. And so we've worked on that challenge, this husband and wife and their attorney with us at the Giving Crowd for about 8 months. And in December of that year, he and his wife transferred 40% non-voting stock down into a donor advised fund. Well, again, as we said earlier, this is a tax exempt environment. So there's no long-term capital gain taxes, zero. And in fact, they got a charitable income tax deduction. Now, it wasn't for a full 4 million because we had minority discounts, but just to keep our math easy, I'm using 4 million here. Well, that was in December. The next year, a few months later, they transferred, the boys bought that stock out of the donor advised fund on a 10-year note. So now the stock has gone from the donor advised fund over to the sons. They now own this 4 million. They own 40% of the business. They're getting quarterly distributions out of the company, and that's what they're using to make the note payments. As those note payments are paid off, mom and dad are going to have $4 million plus interest to give away to charity. So to summarize, Dad's goal of rewarding the sons has been accomplished. They now own 40% of the business. They have the incentive that Dad wanted for them to keep growing it. And in fact, if they keep growing the business at 12% or 10% or whatever, their $4 million of stock is going to be worth 8 or 10 million by the time the note's paid off. So they have exactly the motivation Dad was looking for, but Dad paid no taxes. Mom and Dad paid no taxes. They got a big charitable deduction, and we've converted $4 million of family business stock. You remember that, the big jar, that illiquid stuff? We've converted $4 million of that into gifts that they can use to impact the charities that they care about. The real life couple has been giving 50% of their adjusted gross income to charity for more than 30 years. This is the first time they ever gave out of assets instead of out of their checkbook. So it was a big deal for them. It was a big transformation for them. Well, those are 3 quick examples of what we do. I've got one more, but I think for the sake of time, I'm gonna skip this one. I'm happy to do that another time privately if you'd like. But Richard or I would be delighted to just have a conversation with you, just to explore. We're pretty low key. If we can be helpful, we'll tell you. If we can't, we'll tell you that. Sometimes people ask us, can you do such and such? We say, well, no, we really can't, and here's why. So we'll just have a conversation with you and your financial advisor with Ameriprise, and see if we can be helpful to you. So we'd love to do it. reach back out to your advisor who invited you to this, and then he or she can set up a Zoom call at your convenience. Probably have to be a couple weeks out, but we'd be happy to do that, and hope that we can. Hope you found this to be helpful. Thank you for those of you that are already just deeply involved in generosity. You are the lifeblood of so many charities around the country, and America has the most generous tax system in the world in terms of encouraging generosity. And what we have shown you today is just a few things that are in the code that probably you weren't familiar with before. So that's where we would like to serve you, is to bring those to bear on your situation in a way that we hope will take you from involuntary philanthropy to voluntary philanthropy. All right. Thanks so much. We have recorded this session, so if you'd like a copy of it, you can get that from your Ameriprise advisor, and look forward to talking sometime soon. Thanks so much. Bye-bye.